When we analyze a chart, we need to ask ourselves, what are we really looking at? Are we just seeing random price movements, or is there a deeper structure to it? Just like we trained our eyes to see dinosaur bones in a fossil dig, we need to train our eyes to spot pivot highs and pivot lows in the market. These are the key points that form the structure of price movement, helping us make sense of market trends and reversals. So, to begin, we take a chart and measure from the lowest point to the highest point. That's our starting point. We track the pivot low and the pivot high, marking them clearly. These points act as our reference markers, allowing us to analyze how price behaves between them. Then, we measure how much the price moves up and how much it comes down. Identifying these movements helps us recognize patterns and potential opportunities in the market. Let's say the price moves up by 50. That could mean $50, 50 pips, or 50 ticks, depending on the market we're analyzing. The exact unit depends on whether we are trading Forex, stocks, or futures. Then we track the pullback. Let's say it retraces 25. This means that the price is correcting before potentially making another move. Understanding these retracements helps us gauge market strength and identify potential entry and exit points. Next, we do the same for the next leg up and down, continuing this process to gather numbers that help us understand the overall movement of the market. By tracking these waves of price action, we can start identifying trends, support and resistance levels, and even potential reversal zones. Once we have these measurements, we start looking for patterns. What's the trend? If we see a series of higher highs and higher lows, that tells us we're in an uptrend. Some people call this a bull pullback, but at its core, it's simply an uptrend. Now, we ask the key question, what's the average bullish run? In this case, we see that each bullish push goes up by around 50. That gives us our baseline expectation for future moves. But where do we make the most money? To answer that, we take our numbers and calculate an average. This isn't complicated, it's basic math, something we all learned in middle school. We add up the bullish runs and pullbacks, divide by the number of instances, and get an average projection. That number is crucial because it tells us what we should expect in future price movements. This projection gives us an idea of how far price is likely to go. But price movement alone isn't enough, we also need to factor in time. So we do the same process, but instead of measuring price, we count bars on the chart. Let's say the first bullish push took 10 bars, then the pullback took 8 bars, the next move up took 6 bars, and the following pullback took 4. We total these numbers, find the average, and now we have a projected time frame for how long the next move should take. This gives us a complete picture, a projection in both price and time. Now, let's talk about something that's absolutely certain in the market. While nothing in trading is ever 100% predictable, there are a couple of absolute truths. First, the market always moves from pivot low to pivot high, then back to pivot low. We don't always know the magnitude of these movements, but we do know this cycle will continue. Second, the market always moves to the right. Time never stops, and the chart will always print the next bar. So, using our projections, we can create a target, a point on the chart where we expect price to reach within a given time frame. This is our ideal scenario, but of course, markets are not always ideal. Once we have our projection, one of 3 things will happen. First, we could be wrong. The market could move against us, and if price crosses below a certain level, we know it's time to exit. That's our fail-safe. If the price crosses this line, we go into fix-it mode or get out of the trade to minimize risk. The second possibility is that the market moves in our favor but stalls. Imagine our target is 37, but the price only reaches 20 and starts moving sideways. Most traders in this scenario will feel okay because they're in profit. They tell themselves, I'm up 20. My target is 37. I'm halfway there. I'll just hold. But holding on to a trade just because it hasn't hit your exact target can be a dangerous mindset. The market doesn't always move in a straight line, and recognizing when momentum slows is just as important as setting a target in the first place. The key takeaway is that we use these projections to make informed decisions, not rigid rules. We measure price and time, look for patterns, and set reasonable expectations. But at every step, we remain flexible, knowing that the market can always move in unexpected ways. By balancing structure with adaptability, we put ourselves in the best position to trade effectively. All right, let's go back to this bell curve and think about it in terms of time. So we've just gone 7 bars and we already know that's a pivot. What's coming next? This is a pivot low, so naturally what comes next is a pivot high. Now let's say we go 8, 9, 10 bars. Where's your probability? The probability is that it's going to pivot and come down. And this is where the natural instinct kicks in. People say, I'm going to hang on, but what should be the right response? You need to be fearful here. The market is turning, and you need to get out. Think about it like this: markets move in cycles. You've seen this pattern before. Price goes up, then it peaks. Price goes down, then it bottoms out. This happens over and over again. And here's the key: when we hit that pivot high, the market is running out of steam. It doesn't matter how strong the last move was, at some point momentum fades. Now, what do most traders do? They hold on, thinking it'll keep going just a little further. But what happens instead? They give back their profits because they ignored the time factor. This is why you need to be aware of time as much as price. It's not just about how high or how low the price goes, but it's about when the move is due to reverse. So, if you've already hit 7 bars and you push into 8, 9, 10 bars, what's your probability? The probability is shifting. The market is getting ready to turn. And what should your response be? Not hope, not greed, but risk management. Because the moment you start ignoring time, the market will teach you a lesson. What best traders do? They're not trying to squeeze every last pip out of a trade. They take high probability setups and exit before the market turns against them. This is how you stay in the game long term. So, when you see that 7 bar pivot, you already know the next move is likely a reversal. And what if you're still in that trade? You're not in control anymore, the market is. That's why the smart move is to take your profits, manage your risk, and get ready for the next setup. Now let's go a step further. Do I exit a trade just because the price has moved in my favor? This is an important question, and it leads us to the third possibility: we could actually be right. Even the worst trader in the world is correct some percentage of the time. Most traders think, if the price goes up 10 pips, I should take my profit and exit. But we need to analyze this statistically, not emotionally. What are emotions day? I have a house payment. I need to pay bills. I want to go on vacation. These are emotional reactions, but emotions do not lead to the best trading decisions. Instead, let's focus on logic. If the price moves more in less time, what does that indicate? It means momentum is in our favor. There is debate about whether markets are trending by nature. Some argue that they are random, as discussed in Malcolm Gladwell's book Fooled by Randomness. However, I believe markets do follow trends. If the market is moving in a strong trend, and we have identified momentum, what is the correct response? This is the time to be aggressive, not fearful. Being aggressive does not mean reckless trading. It means understanding when to hold onto a winning position and let the market work in your favor. Greed, when applied strategically, can take different forms. Holding onto the trade longer to maximize profits. Adding more positions as the trend develops. The worst response is to exit a winning trade just because it is in profit. Exiting too early limits gains and prevents traders from taking full advantage of strong momentum. The goal is not to take quick, small profits. The goal is to capitalize on high probability setups and maximize returns when the market is moving in your favor. Now let's talk stop losses. Should we move stops to break even? Sometimes, but we have to be careful. If we move it too close, volatility can take us out. This is why traders get stopped out and then watch price move in their favor. The market naturally fluctuates, and a tight stop just lets that volatility shake us out. That's why I take multiple positions. My first goal is always to mitigate risk and book small profits while keeping a portion running. Whether I nail the entry or not, I keep adding and adjusting positions as price moves. I don't have to be perfect. I just need to manage my risk while giving myself a chance to catch the bigger move. And that's how we do it. Now let's look at this example. Here we have the pound sterling to US dollar 1 hour chart. I have already measured these higher highs, and as you can see, we have 553, 253, 434, 377, 590, and 244. Now, what do these numbers represent? These are the measured pip distances between significant highs, and they give us insight into the market's rhythm. By analyzing these values, we can start identifying potential patterns and anticipate where the next movement might occur. When we see a sequence like this, we ask, is there a repeating cycle? Are these numbers clustering around a specific range? Is there a relationship between time and price? All right, we have a bullish trend and we have already measured price. Now it's time to measure time. As you can see in the chart, I have already measured and plotted the time intervals, which are 38, 15, 12, 14, and 12. These numbers represent the number of bars between key turning points. Just like we analyzed price distances, measuring time cycles helps us understand the rhythm of the market. Now, the key question is, do we see a repeating time pattern? Is there a cycle forming? Now, both the time and price intervals indicate that we are making higher highs, confirming that the bias is bullish. Next, we will calculate the average of both time and price. To do this, we add up the price intervals and time intervals separately and then divide each by the number of data points. In this case, we divide by 6 since we have 6 measured points. Our price range average is 408.5 and time range average is 15 bars. This means that, on average, the market is moving 408.5 pips in price over 15 bars in time. With this information, we can now project potential future price movements. If the trend continues, we should expect the next price move to be around 408.5 pips over the next 15 bars. This gives us a high probability zone to anticipate the next trade setup. I have plotted the 408.5 price range and 15 bars for time on the chart. Based on this analysis, I am anticipating a move of approximately 408.5 pips within the next 15 bars. Since both the price and time averages align with the previous trend, this projection helps us identify the next potential pivot zone. If the trend continues, we should expect price to reach this target within the estimated time frame. As we can see on the chart, price is already at a higher time frame key level, which adds confluence to our analysis. Since we are in a bullish trend and the measured price and time intervals suggest continuation, we can anticipate a bullish reaction from this level. We will enter at the key level, placing our stop loss below a significant low to protect against potential downside risk. Our target will be the 408.5 pip range, aligning with the measured price movement. We anticipate this move to be completed within 15 bars, based on the calculated average time interval. If price follows the expected trend and momentum remains strong, it should reach our target within this time frame. As expected, our target was reached. The average time and price calculations worked perfectly in this trade, giving us a precise entry, stop loss placement, and an accurate target. This confirms the effectiveness of using time and price confluence to anticipate market movements. By aligning our entry with the key level and targeting the 408.5 pip range within 15 bars, we executed a high probability trade with a clear structure. This setup reinforces the importance of measuring both price and time to improve trade accuracy and confidence. Let's look at another example, this time using the Australian dollar to US dollar pair on the daily time frame. I have already measured the price ranges, which are 838, 451, 604, and 451 pips. These values represent the measured price swings between key highs and lows, helping us identify potential repeating price patterns. Now, our next step is to analyze the time intervals between these moves. By combining both price and time, we can project the next potential market movement with higher accuracy. Let's measure the time cycles and calculate the averages to anticipate the next setup. Alright, now that we have the time intervals, that is 28, 17, 20, and 21 bars, which I have already plotted. Now we will calculate the average of both time and price values. We sum up the price and time values separately and then divide by the number of ranges, which in this case is 4. Price range average is 586 pips, and time range average 24 bars. This gives us an expected price movement of 586 pips within 19 bars. Now, using these values, we can anticipate the next potential move. If the market respects the pattern, we should see a price move of around 586 pips within 19 daily bars, allowing us to position our entry, stop loss, and target accordingly. If the price is already at a higher timeframe resistance level, it increases the probability of a downward move, making it a potential shorting opportunity for Australian dollar to US dollar. However, before entering a short trade, it's important to look for confirmation. Watching price action for bearish signals like engulfing candles or pin bars can help determine if the level is holding. Checking lower time frames for a break of structure or a shift in momentum can provide additional confidence. Fundamental factors, such as upcoming news events, should also be considered, as they can impact price movement. If all signs align, a short trade can be a good opportunity, with a stop loss placed above the resistance level and a target near the next support zone. Now, after confirming the bearish bias, we will place our short trade at the key level based on our analysis. With an expected move of 586 pips within 19 bars, we will set our stop loss above a significant high to protect against invalidation and aim for the projected price target. Now, we let the market unfold and monitor price action closely. If the pattern holds, we should see the price moving in our favor within the expected time frame. And here we go. The price moved directly to our target profit and respected the expected range perfectly. This trade once again validates the importance of combining time and price analysis. By measuring historical price movements and time cycles, we were able to anticipate the next move with accuracy. Price and time confluence helped us determine the trade's potential move, and entering at a strong resistance level ensured a high probability short trade. With a proper stop loss above a significant high, we managed risk while allowing the trade to reach its full potential. The market respected historical patterns, reinforcing that time and price relationships are essential for trade forecasting. The best way to master this method is through consistent practice, journaling, backtesting, and forward testing. Journaling your trades helps track progress and refine decision-making.